The data we have just pulled from the CME servers is not just a statistical anomaly, it is a historical event. We are looking at a delivery report that changes the entire complexion of the silver market. For the last 48 hours, we have been warning you that the China export ban would break the supply chain. We warned you that the banks were trapped. We warned you that the physical market was divorcing the paper market. But what happened today at 2:30 p.m. Eastern Time goes beyond any warning we could have issued. We are witnessing the ghost of 1980 return to the trading floor. We are witnessing a physical grab for metal that we haven't seen since the days of the Hunt brothers. Ladies and gentlemen, Asian guy here, known as John A.G. from Currency Archive. I have the CME Group delivery report right here in front of me. Let's look at the raw numbers because numbers do not lie. Today, Friday, January 2nd, the exchange issued 1,168 delivery notices. That is 5,840,000 ounces of silver demanded in a single session. But if you zoom out just 24 hours, if you combine today's report with the massive spike we saw yesterday on New Year's Day, the total number of contracts standing for delivery in the first 2 days of 2026 is 3,446. Let me say that number again, slowly, so you can visualize the mountain of metal it represents. 3,446 contracts. Multiply that by 5,000 ounces per contract. That is 230,000 ounces of physical silver moved in 48 hours. To put that into perspective, you have to understand the geology and the industry of mining. The global mining industry, from the freezing pits of Russia to the high-altitude mines of Peru, produces roughly 800 million ounces a year. That is the total annual budget of Mother Earth. That means in the first 2 days of the year, before most traders have even returned from their holiday vacations, before the coffee is even hot on the desks of the London Fix, the COMEX has been forced to cough up 2% of the entire annual global production. This is not commercial hedging. This is not industrial flow. A factory does not order 17 million ounces of silver on a Friday afternoon just to make iPhones. This is a run on the bank. This is a sophisticated, coordinated, and violent raid on the exchange's physical inventory. You have to understand the significance of the date. Why January 2nd? Why the rush? Why the violence in the price action? Because as of this morning, the China export ban is live. The China wall we talked about is now a reality. The supply from the east has been cut to zero. The pipeline that usually feeds the Western deficits, the silver that flows from the Shanghai refineries to the London vaults and then to New York, has been welded shut by the CCP, and the sharks in New York know it. They know that the 39 million ounces sitting in the registered vaults are the last easy ounces left on planet Earth. They know that once those ounces are gone, the price goes to no offer. So, they didn't wait. They didn't dip their toes in, they didn't try to finesse the market with algorithms. They smashed the buy button and demanded delivery of 17 million ounces instantly. They stripped nearly half of the available registered inventory in 2 days. If this pace continues for another 48 hours, the COMEX breaks. Mathematically, it cannot survive another week of this pressure. We are watching an inventory liquidation event disguised as a trading session. And the most terrifying part of this report isn't just the volume, it is the intent. When you see 17 million ounces move in 1980, it was two brothers from Texas trying to corner the market. It was cowboy capitalism. Today it isn't a couple of cowboys, it is the banks themselves. We are seeing a phenomenon that signals the end of the suppression cartel. We are seeing cannibalization. The banks are no longer working together to hold the price down. The truce is broken. They are now eating each other to secure the lifeboats. When you look at the issuer and stopper data, the list of who sold the silver and who bought the silver, it reveals a brutal war taking place behind the scenes. Usually the banks pass the silver back and forth like a hot potato to keep the game going. Bank A sells to Bank B sells to Bank C, and nobody actually takes the metal out of the vault. It is a paper shuffle. It is a confidence game designed to make you think there is plenty of liquidity. But today the music stopped and the potato was frozen. The metal stopped moving in a circle and started moving in a straight line. Out of one bank's vault and into another bank's fortress. One major institution was forced to bleed. One major institution was forced to vomit up millions of ounces of precious inventory that they desperately needed to keep to satisfy their capital requirements. And another major institution, one that used to be their ally in the rigging game, stood there with a bucket and caught every single drop. This is what happens when a currency dies. This is what happens when the paper derivatives market realizes it has leveraged itself 400 to 1 against a physical asset that is disappearing. The thieves stop stealing from the public and start stealing from each other. We are watching the breakdown of the gentleman's agreement that has suppressed silver for 40 years. There are no gentlemen left on Wall Street today. There are only predators and prey, and the prey is currently bleeding out on the floor of the exchange. So who is the victim? Who is the issuer that just lost 3 million ounces of silver in a single day? And who is the blue whale that just swallowed 80% of the market? The names on this report will shock you, because it turns out that the biggest buyer of physical silver right now isn't a Reddit ape, it isn't a coin shop, it isn't Elon Musk. It is the very bank that created the paper short position in the first place. They are flipping the script, they are switching sides, and they are destroying their competition to do it. Let's look at the combatants. Let's look at the blue whale raid. And while the giants are feasting on the carcass of Deutsche Bank in the wholesale market, sucking up 4 million ounces of industrial bars before they can even touch the pavement, the situation for the little guy, for you, for me, for the average family trying to secure their savings, has gone from difficult to impossible. We are witnessing a total blackout of the retail supply chain. If you think the raid on the COMEX was violent, you should see what is happening on the websites of the major bullion dealers right now. It is a digital ghost town. The inventory is gone. The shelves are bare. The buy buttons have been replaced with notify me buttons, which is just a polite way of saying, you are too late. I have been monitoring the inventory feeds of the big 3 online dealers, SD Bullion, Kitco, and AppMex, since the market closed today. And the data confirms that the retail Armageddon we feared is no longer a forecast. It is here. Let's start with SD Bullion. This is one of the largest volume dealers in the United States. They usually have tens of thousands of coins ready to ship. As of 7:00 p.m. Eastern Time tonight, their product page for the current year American Silver Eagle displays a terrifying message. Out of stock. But it gets worse. Usually when they are out of stock, they give you an estimated shipping date of maybe 2 weeks. They take your money, they hedge the position, and they ship it when the mint sends it. Tonight, the estimate says, next shipment, March. March. We are in early January. They are telling you that for the next 8 weeks, there is zero inventory coming in. Why? Because the U.S. Mint cannot get the silver blanks. And why can't the U.S. Mint get the silver blanks? Because JP just bought all the silver bars that the Mint uses to make them. The blue whale ate the feedstock. You are looking at a supply chain starvation event. Now let's look at Kitco. Same story. You go to their Silver Eagle page and you don't even get a price. You get a grayed out box that says unavailable. They aren't even taking back orders. They have closed the order book completely. This is significant because dealers usually love back orders. It is an interest-free loan from the customer. When a dealer refuses to take your money for a future delivery, it means they are terrified that they won't be able to source the metal at any price. They are afraid of defaulting on you, so they are choosing to shut down the business rather than take the risk of selling you an ounce they cannot find. And then there is AppMex. AppMex is the dealer of last resort. They always have metal because they charge the highest premiums. They are the true price discovery mechanism for the desperate buyer. And right now, they do have some Eagles in stock, but look at the price. I am looking at the live listing for a single random year American Silver Eagle. The price is $89.07. Let that sink in. $89. The COMEX spot price, the price the banks are trading at, the price you see on CNBC, is $71. That is an $18 premium. That is a 25% surcharge just to get your hands on the metal. And that is for a random year, scratched up coin. If you want a brand new, mint condition coin, the price is pushing $95. This is the bifurcation in its rawest form. JP pays $71 because they buy 4 million ounces. You pay $89 because you buy 1 ounce. The wholesale discount has become a retail tax. The banks have effectively fenced off the cheap silver for themselves and left the retail public to fight over the scraps at a massive markup. And do you know why the premiums are exploding? It isn't just greed, it is replacement cost. The dealers know what just happened on the COMEX. They saw the delivery report. They know that JP and Citigroup cornered the market today. They know that tomorrow, when they call their wholesale suppliers to restock, the phone isn't going to be answered. Or if it is answered, the price is going to be $10 higher. So they are raising their prices tonight to protect themselves. They are pricing in the scarcity that JP just created. This is the trickle-down effect of a bank raid. First, the big banks raid the exchange, then the mints run out of industrial bars, then the dealers run out of coins, and finally the premium shoots to the moon. We are in the final stage of that chain reaction. And if you think you can just switch to generic rounds, the Buffalo rounds or the simple bars, good luck. The premium on generics has jumped from $2 to $8 overnight. Even the junk silver, the old pre-1964 dimes and quarters that nobody used to want, is trading at a 40% premium over its melt value. There is no cheap silver left. The tide has gone out and there is nothing on the beach but sand. So, if you are sitting there waiting for a dip to buy, you are looking at the wrong chart. The paper chart might dip to $65 tomorrow if the banks decide to play games with the algorithms. But the physical price at AppMex isn't going to $65. It is going to $90, then $100. Because the supply is gone, you cannot buy what doesn't exist, no matter what the chart says. And where did all that supply go? It didn't just vanish into thin air. It moved from the available pile to the unavailable pile. We need to track the movement of the inventory. We need to look at the vault data from tonight to confirm the damage. Because while the dealers are sold out, the vaults in New York and Shanghai are bleeding out. The drain we witnessed today in the registered inventory is the mathematical proof that this squeeze is terminal. Let's look at the vault numbers. Let's look at the drain. And the drain is not a trickle. It is a hemorrhage. While the retail websites are flashing sold-out signs, the official inventory reports from the world's two largest exchanges, the COMEX in New York and the Shanghai Futures Exchange in China, are confirming that the physical foundation of the market is crumbling. We just received the end-of-day clearing report for the COMEX vaults, released at 5 p.m. Eastern Time, and the number is devastating. The registered silver inventory, the metal that is actually available to settle these massive delivery demands, has crashed to 39.4 million ounces. In just the last 24 hours, we saw a net withdrawal of 2.8 million ounces from the registered category. Now connect the dots. Deutsche Bank delivered 3.2 million ounces today. JP Morgan and Citi stopped 4.4 million, and the inventory dropped by 2.8 million. This tells us exactly what happened to the metal. It didn't just switch owners and stay in the vault. It was removed from the market. JP Morgan didn't buy that silver to trade it. They bought it to bury it. They moved it from registered, available, to eligible, not for sale, or they loaded it onto armored trucks. That is 2.8 million ounces that will never be sold at $71 again. It is gone. It has been permanently sequestered by the banking cartel. And if you think 39 million ounces sounds like a lot of metal left, you are mistaken. We just saw 17 million ounces of demand in 48 hours. Do the math. 39 million divided by 17 million. At this current burn rate, at this current speed of bank-on-bank rating, the COMEX has roughly 2.5 days of inventory left before it hits absolute zero. 2.5 days. We are staring at the bottom of the barrel, but the collapse isn't just happening in New York, it is a global synchronized drain. We also just got the nightly inventory numbers from the Shanghai Futures Exchange, SHFE. Remember, China just reopened today after the holiday, and the moment the doors opened, the vacuum turned on. The total silver inventory in the Shanghai vaults has fallen to 681 metric tons. They lost 46 tons in a single trading session. Let's translate that. 46 tons is roughly 1.5 million ounces. So on the very first day that the new export ban went live, the Chinese domestic market consumed 1.5 million ounces of its own stockpile. This confirms our worst fear. The Chinese market is panicked. The industrial buyers in Shenzhen and the solar manufacturers in Jiangsu are not waiting. They are looting their own exchange because they know the export ban means no new metal is coming in from abroad, and they can't get metal out. They are trapped in the cage with a hungry tiger, and the only food left is that 681 tons. At a depletion rate of 46 tons a day, the Shanghai exchange goes dry in 14 days. So, look at the global picture. New York is bleeding 2.8 million ounces a day. Shanghai is bleeding 1.5 million ounces a day. That is nearly 4.5 million ounces of physical silver vanishing from the visible stockpiles every single day. And the mines? The mines only produce about 2 million ounces a day. We are running a daily deficit of 2.5 million ounces. The math is broken, the buffer is gone. We are literally watching the exchanges run out of product in real time. This is why JP Morgan panicked. They see these numbers before we do. They saw the Shanghai drain starting this morning. They saw the COMEX levels dropping. And they realized if we don't grab the metal from Deutsche Bank today, there won't be any metal left next week. The inventory data is the smoking gun. It proves that this isn't a speculation bubble. It is a resource crisis. The world is running out of silver at these price levels, and the repricing event is the only way to stop the bleeding. And this brings us to the final conclusion. We have the delivery spike, we have the bank raid, we have the retail outage, and we have the vault drain. What does it all mean for Monday? What does it mean for the solvency of the system? JP Morgan just spent hundreds of millions of dollars to corner the market. Are they at risk, or is the risk somewhere else? Let's wrap this up with the bottom line. Let's look at the end game. And this brings us to the final calculation, the bottom line of the balance sheet. We have watched the physical inventory evaporate. We have watched the retail supply chain collapse. We have watched the sharks turn on each other in the wholesale market. But there is one final question that is flooding my inbox right now. It is the question every End the Fed channel is asking. Is JP Morgan bankrupt? Did this raid break the banks? Is the system insolvent? We need to be adults here. We need to put away the fantasy and look at the cold, hard arithmetic of bank capital, because if you misjudge the enemy's strength, you will lose the war. Let's look at the risk math of today's transaction. JP Morgan and Citigroup combined took delivery of 4.42 million ounces of silver today. At the current spot price of $71 per ounce, what is the total dollar value of that metal? Do the multiplication. 4.42 million times 71. The total cost of the raid was roughly $314 million. Now, to you and me, $314 million is an unimaginable fortune. It is enough to buy an island. But to JP Morgan? JP Morgan currently holds $165 trillion in Tier 1 capital. Citigroup holds roughly $240 billion. So, let's do the percentage. $314 million represents 0.02% of their combined safety buffer. Let me repeat that. 0.02%. It is the financial equivalent of you buying a cup of coffee. It does not dent their balance sheet. It does not threaten their solvency. It does not trigger a margin call from the Federal Reserve. If you are waiting for JP Morgan to collapse because they had to pay $300 million for silver, you are going to be waiting a very long time. They have the digital printing press behind them. They have infinite liquidity. The dollar squeeze is a myth. They will never run out of dollars. But, and this is the most critical but of the entire year, while the financial cost was negligible, the physical signal is deafening. If the cost was so small, if $300 million is just pocket change for Jamie Dimon, why did they do it? Why did they break the unspoken truce with Deutsche Bank? Why did they drain the registered vault to dangerous levels? Why did they risk creating a retail panic? Because while they have infinite dollars, they know there is finite silver. They raided the market today, not because they had to spend the money, but because they had to secure the metal. They know that the $314 million they spent today bought them 4 million ounces. But they also know that next week, that same $300 million might only buy them 2 million ounces. And next month, it might buy them nothing. This proves that the crisis is not about solvency. It is about availability. It is a physical lockout. The banks are effectively converting their worthless paper fiat, which they can print for free, into the only asset that China, Samsung, and Tesla are fighting over. They are swapping the fake asset for the real asset at a speed we haven't seen since 1980. They are front-running the inevitable revaluation. They are not the dumb money getting squeezed. They are the ruthless money doing the squeezing. They are squeezing Deutsche Bank. They are squeezing the retail buyer. They are squeezing the industrial user. They are gathering the remaining chips on the table before the casino lights turn off. And this redefines the battlefield for Monday morning. We are no longer looking at a paper short squeeze where we hope the price goes up so the banks lose money. The banks have already hedged. They have already switched sides. They are now long physical. We are looking at a bank-on-bank war for survival. It is Deutsche Bank versus JP Morgan. It is the West versus the East. It is the haves versus the have-nots. And in this war, the spot price of $71 is just a number on a screen. It is a tool of deception. While the ticker says $71, the inventory says critical. While the ticker says $71, the retail shelf says sold out. While the ticker says $71, the Shanghai vault says 46 tons. So here is the bottom line. For the first 48 hours of 2026, we have witnessed a 17 million ounce delivery spike, a level not seen in 46 years. We have witnessed the cannibalization of a major bullion bank. We have witnessed the closure of the retail window. And we have witnessed the acceleration of the vault drain. This is not a drill. The Silvergeddon scenario is live. The physics of the market have taken over. The paper price is now irrelevant. The only thing that matters is possession. If you have it, you win. If you are waiting for a dip, you lose, because by the time the dip comes, the inventory will be gone. Do not look at the chart. Look at the vault. Do not listen to the Fed. Listen to the sound of 3 million ounces leaving Deutsche Bank. The war has started, and the banks just fired the first shot at each other. Hold fast, stay safe, and never ever sell your physical for their paper. This is John A.G. signing off from the front lines of the Silver War. I will see you on Monday. Like, subscribe, and share.